Hello and welcome back to our channel. In today's video, we're going to discuss an investment strategy called dollar cost averaging. Dollar cost averaging is a strategy where an investor invests a fixed amount of money in a specific investment at regular intervals, regardless of the price. This approach allows investors to avoid the risk of investing a lump sum at the wrong time and instead spreads out the investment over time. The idea behind dollar cost averaging is to invest the same amount of money in a particular investment on a regular schedule, such as monthly or quarterly, over a specific time period. By doing so, the investor is buying more shares of the investment when the price is low and fewer shares when the price is high. Over time, this approach can result in a lower average cost per share and can help reduce the impact of market volatility on an investor's portfolio. Here is an example. Jane wants to invest $10,000 in a stock but is concerned about market volatility. Instead of investing the entire amount at once, she decides to invest $1,000 each month over 10 months. Over the 10 months, Jane ends up investing $10,000, and because of dollar cost averaging, she buys more shares when the price is low and fewer shares when the price is high. That's all for today's video. Thank you for watching, and please don't forget to like and subscribe to our channel for more content.